Hey guys, welcome back to another video. This is Makia Forex, and on this video I want to teach you guys a very important tool which is very important for your trading. It's what I call the average trading range. You know, whenever the market moves in a particular day, there's an amount of pips it can move in a certain day, and as forex trader we cannot get into the market and put let's say high hopes or high expectation of the amount of movement in a particular day. Meanwhile, we know that the market has a maximum amount of pips it move in a certain day. So pairs like gold has a different amount of pips it can move in a certain day. Pairs like GBP USD, Euro USD, they all have different pairs, different amount of pips which they can move in a certain day. So a pair like GBP USD can move about, let's say, in the range of 60 to 90 pips in a certain day, and you know, very active days it can move like, let's say, 70 to 90 pips. So when you're a trader and you're coming into the market, let's say you're coming into the market in the London session, you have to look at the amount of movement of pips in the Asian session before going into your trading. So let's say if you're going for a buy, you shouldn't be expecting the market to move up about 100 pips or 150 pips. Meanwhile, the market has moved already about, let's say, 50 pips in the Asian session. Just the same as those that are trading in the New York session, you can't come into the New York session knowing fully well that the market has moved up about 70 pips in both in the Asian session and the London session, and you start expecting the market to move up about 80 pips again. You find yourself in losing trades, if you know what I'm saying. Now let me explain to this thing carefully. In this particular case, I want to use the 15 minutes time frame, and I'll use the Asian range strategy, which I'll just put it on like this. Okay, so these lines, right, these lines is what I call the Asian range, and it actually represents the different trading sessions in the particular market. So this is Monday, this is Tuesday, Wednesday, Thursday, and this is Friday, if you know what I'm saying. So this blue line is the Asian trading session. It begins from 1 a.m. to 4 a.m. that is in GMT plus 1. So the London session begins from 8 to about 4 p.m. and then it will interlap with the New York session, which begin from 1 p.m. to about 9. So I hope you guys know about this thing. So my main goal is that I have to look at the amount of movement of pips in the Asian session. So with this in my mind, I can know how much the market can move in the London session. I want to use the 15 minutes time frame because it's very important. Let me go to Monday. This is the movement on Monday. Okay, right now let's say for this particular case we are in a bullish market, and this is what happened during the Asian session. This is the Asian range. I'll put my rectangle tool for that particular aspect. From 1 a.m. to about 4 a.m. that's the Asian range every single day. So this is what happened during the Asian session. I have to measure the amount of movement in the Asian session. So I'll begin from this area, from the low to the high. It has moved about 34 pips in the Asian session. This is what happened from the low to the high. It has moved about 34.1 pips. So now let's say I am supposed to enter a buy in the London session, because you know GBP US is mostly bullish in the London session. That's if the market is actually bullish. I have to put in the back of my mind, okay, if the market has moved about 34 pips or 31 pips in the Asian session, I should expect the market to move about 50 pips in the London session. So if I'm putting my take profit and my stop loss, I should be aware of these things at the back of my mind. So I shouldn't put a very high take profit, like let's say 200 pips, 150 pips, especially if I'm a day trader. So if you're a long-term trader, it's okay, but if you're a day trader, you have to, you know, calculate your market risks ahead of time and know, okay, if I'm supposed to go in for a buy, I'm supposed to manage my trade and don't over expect or don't over stretch the market out. So I may decide to go in for a buy at the open, especially when I see a pullback in the London session. If I enter a buy here, let's say I will enter a buy, I'll put my stop loss just at the swing low of this particular session like this. So my stop loss can be around here, just beneath the swing low like this. Okay, then my take profit, I can put my take profit right now to this particular area, this particular area, because of what happened there previously in the last day. So right now, for those who are trading, right, you have to make sure that your take profit shouldn't be more than 100 pips, because the market has already moved, let's say about 30 pips in the Asian session. Now let me calculate the movement in the London and the New York session. This is my ruler tool. I'll start from here. This is a low of the London session. Okay, up to this area where we have the overlap. So what do we see? We see about, let's say, 50 to 60 pips movement in this particular trading session. So this gives us an idea on how much the market can move in a particular trading session. So let's say if you're coming in the New York session, you can't be expecting to put, let's say, 80 pips move. You're putting your take profit one at 80 pips when you know that the market may never reach that level. So these things are very important as a forex trader. You are supposed to go through your pair, the pairs that you're trading. You are supposed to know how it moves in a certain day. Is it 80 to 100 pips, or is it 70 to 100 pips? So with that at the back of your mind, you can measure your stop loss, and you can also measure your take profit, so that you do not put, let's say, exorbitant take profit. Let's say you're coming in the New York session, like in this particular case, and you're putting your take profit around this area. That will just be a failure as a trader. Let's say you're coming into the New York session, like in this particular case, and you put your take profit in this particular area, 30 pips, and you're coming in late and you're putting a 50 pip moves. You may end up losing this trade, not because you're a bad trader, but because you're doing the wrong timing. And in case if you're a day trader, you are supposed to close the market before the end of the day, so you may find yourself in a losing trade, or you may find yourself not really reaching out to your expectations because of your wrong calculations. Okay, let me just take this case of this particular swing low, this bearish move. This is the Asian session. This green or blue area. This is the Asian session. From this area, this is the Asian high and this is the Asian low. Let me calculate the movement. You see, it's about 25 pips. So this movement is about 25 pips in the Asian session. Now I'm expecting that the market should be more, volatile, or more, let's say, flexible in the London and the New York session. So if he has already moved 25 pips in the Asian session, I should expect the market to move about 50 to 60 pips in the New York session. So you're supposed to calculate these things every single day. You know what is the average trading range of a particular pair. For pairs like GBP USD, I said it already, the average trading range is about 60 to 80 pips a day, or let's say from 60 to 70 to 100 pips in a good trading day. Pairs like gold, they have a much bigger average trading range. So you're supposed to know how much you're supposed to know how much a pair can move in a certain day, so that if you're trading, you should not be coming in, let's say, in a session and you're putting a very, very big take profit. Meanwhile, you might not be able to hit that take profit, because it may get to your take profit one and then it starts reversing, because it has already exhausted the amount of movement it can do in a particular direction that certain day. So let me just do it again. This is what happened in the London session. Okay, you can see in the London session it made about 34 pips, and this is the New York session, 50 pips in the New York session. So averagely on this day, the market moved for about 100 pips. You see, so if you're coming in, let's say in the New York session, you can't be putting your take profit at 100 pips, or let's say or 80 pips. Meanwhile, the market has moved already about 80 pips in this both in the Asian session and also in the London session. So it's very important for you to know the times of the day you're trading and how much movement the market has already done in the previous session, so that if you're putting your take profit targets, it should be in respect to what you expect the market to move before the close of that particular trading session. You can still decide to swing trade and put a bigger stop loss and a more flexible take profit bet. If you're a day trader, it's important for you to know how much the market can move in a particular trading day. So that's pretty much it for this video. You can go behind and back test this thing. Back test it is very important. What do you think about this video? Leave your thoughts in the comment section. Also, you join our group on Telegram, follow us on Instagram, Twitter, and also please join our recommended broker. I'll leave the links in the description. Bye.